A noble profession that is underpaid and underappreciated in this country, that's for sure.
That does it for us on Power Lunch. We'll see you tomorrow.
For our European viewers, Europe Tonight is next. For the rest of you, here's a very important edition of Street Signs with Aaron Burnett.
Hello and welcome to Street Signs. I'm Aaron Burnett. The story today, the Fed. We get one of the most anticipated decisions in 4 years on interest rates at around 2:15 Eastern. Has the Fed already gone too far? Is recession a real risk today? And how can you make money as rates keep climbing? And when Street Signs wraps up today, you may need to make some big decisions about your home, your credit cards, and other loans. You're going to be ready once we're done with you. Well, senior economics reporter Steve Leisman is here to set the table for us. And Steve, here we are in the final countdown. What is the Fed thinking about right now?
Well, let me tell you, Aaron, it's probably been lost on many that the quarter-point hike that we're likely to get in a few minutes will be the first under what is really a new era at the Fed. Not only is this just Ben Bernanke's third meeting along with two new Fed governors, not only are there other changes coming to the makeup of the Federal Open Market Committee, including 2 vacancies, the big change is that the Federal Reserve has moved into an era when it is no longer committing to markets what it will do from one meeting to the next, because it is somewhere near the end of a 2-year, 17-meeting rate hike cycle. It is adjusting interest rates meeting to meeting now based on how incoming economic data affects the economic forecast. And here's the result. For today, higher interest rates. For tomorrow, more and continued uncertainty about what the just to credit cards, to all the stuff that's tied to the Fed and the prime rate.
That's right. Some are saying it's going to be the summer of pain for consumers. You were talking about the issue with inflation versus slowdown. It was interesting, John Riding today from Bear Stearns in the past 4 years. You're watching Street Signs on Cnbc.
The world is getting small.
Miss this live event, the CNBC Survival Guide. It's up, down, sideways. Wall Street's a mess. What should you do? CNBC and the biggest hitters on the street break down the market and steer you through the mayhem. CNBC Survival Guide, tonight, 8 p.m. Eastern. Live from the U.S., Europe, and Asia. Worldwide exchange. CNBC.
All right, let's dig some more now on what we are expecting from the Fed and why. We've got Mike Darter from MKM Partners. We've got senior economics reporter Steve Leisman back with us, and now senior analyst Ron Insana. Thanks so much, all of you. Ron, wanted to jump right in with you because you said something extremely provocative. Not go 100. You said, don't pause, stop.
Well, I think, Aaron, the Fed has done what it's needed to do, which is to get speculative froth out of the housing market, to get it out of emerging markets, and that's with the help of other central banks around the world, which have been tightening monetary policy. And the economy, is not showing at this point the type of inflation that would truly be problematic. I mean, you're still under 2% for certain key inflation measures. So for the Fed,
floor, what are you hearing would make people even more optimistic about equities today?
The market wants to rally going into the close of the quarter. Remember, that's the key thing. The quarter closing with the Fed meeting creates an unusual dynamic. We've had a lousy quarter here. A lot of the fund people I talked to down 4, 5, 6, 7, 8%. If you could pick up a couple of more points here towards the end of the quarter and do it relatively safely, there'll certainly be an impetus to do it. So the theory is here, Fed, best case, Fed raises the and pauses, but a lot of people feel that even if nothing happens, they raise a quarter point and leave the statement the same way it is, the market could well rally right here into that just by people trying to get in here at the quarter. Remember, after that, come Monday and Tuesday, we're going to deal with earnings season, and remember what's going on there, and companies like Advanced Auto Parts are already making comments about impact of higher gasoline prices. We're going to hear a lot more about that.
Yeah, we certainly have a lot on the earnings front. I mean, I know that's the next page to be turned here. Rick Santelli, I know obviously everyone there in Chicago is getting ready for this decision.
Long rates were down because money was pouring in from overseas and people were buying treasury bonds and keeping yields down. This time it looks a little bit more like
the liquidity catalyst is out of the way.
Yeah, and it looks more like people are making an economic bet at the long end than they are just a liquidity, play.
I just want to turn to Mike Darter, if he's still there, about this idea. It looks like, Mike, that the currency vigilantes are the ones running the show these days, and it strikes me that maybe it matters less than they're giving it credit for. It's hard for me to figure out. Here we go. Is that?
I think that
was that a note there?
Maybe about to be it.
My point was it's hard to figure out why 130, 135 is dramatically different for the U.S. economy, say, on the euro, than 125 or 100 on the yen. What's the big deal? We've prospered at all those rates.
Well, sure, Steve, that's a good point. I think that it's really looking at these indicators all together, the currency indicators, the commodity.
The Open Market Committee today decided to raise its target for the federal funds rate by 25 basis points to 5.25%, saying recent indicators suggest that economic growth is moderating from its quite strong pace earlier this year, partly reflecting a gradual cooling of the housing market and the lagged effects of increases in interest rates and energy prices. Readings on core inflation, the FOMC says, have been elevated in recent months. Ongoing productivity gains have held down the rise in unit labor costs, and inflation expectations remain contained. However, the FOMC says the high levels of resource utilization and of the prices of energy and other commodities have the potential to sustain inflation pressures. Although the moderation in the growth of aggregate demand should help to limit inflation pressures over time, the committee judges that some inflation risk remain. The extent and timing of any additional firming that may be needed to address these risks, the FOMC says, will depend on the evolution of the outlook for both inflation and economic growth as implied by incoming information. In any event, the committee will respond to changes in economic prospects as needed to support the attainment of its objectives. The vote for the policy was unanimous. This is Hampton Pearson reporting live from the Treasury Department.
All right, and there you have it, folks. The 17th consecutive increase of interest rates to 5.25% as expected. And you see right now one of the most important reactions we are getting. The Dow is up 83. It's now up about 130 points. Let's go straight to Bob Pisani for a little bit of the initial reaction there. Bob?
Well, what's happened here is that the statement very similar to what we saw last time, and again, we're getting this nice reaction. Remember, the stock market has acted like it's been wanting to go up for 2 days now. The primary mix here is the fact that we've got the end of the quarter coming at the same time as the Fed meeting. A lousy quarter, a lot of traders down rather dramatically. See if they can get some movement here going into the end of the quarter here. Right now, we're seeing a nice volume pick up, a little over 1 billion shares. Bank stocks have moved to the upside nicely. Even the semiconductor index, which has been battered rather severely in the last 2 or 3 days, as that's the big loser, has moved up here very quickly. And now the Dow is up 50 points in 3 minutes. That's a nice move to the upside, Aaron.
Let me get to some details here on the statement here. I want to talk about they've downgraded the economy in the sense that they've gone from the economy is likely to moderate to is moderating, and they talked about that in one other place where they talked about the moderation of growth in aggregate demand should help to limit inflation pressures. It's possible you could read this statement as a step back from an automatic in August, in the sense that last May they said the committee judges that some further policy firming may yet be needed. That seems to be gone. Now they're talking about the extent and timing of any additional firming. They're still talking about firming, but perhaps in a less prescribed or absolutely gonna happen kind of way is the best I can describe it, Aaron. There seems to be, look, what we were hoping for last May, the guys who were the doves were saying, wait, let's have them put in there something about a pause. What's happening is a very incremental move away from automatic gear for the Fed here into a more manual mode.
Did they accomplish that? This what Larry Myers said they needed to do this morning, Steve. Did they accomplish saying, hey, inflation no longer is the biggest risk here, it's a slowing economy?
Well, I mean, I don't think they went that far yet, Aaron. I mean, they did say that inflation pressures, particularly because of resource utilization and energy prices moving up, still present some problems for the economy. But as Steve said, when they mentioned that aggregate demand is slowing or is moderating, that is not a conditional statement anymore as it was last May. And I think that's very important. But they also said that policy firming may yet be needed. They didn't pull that out. They may just have delayed it and may have opened the door for the pause, as Steve suggested.
Oh, and just for fun, Rob, the word yet is gone.
It's gone?
We know Paul McTeer's
I don't know what it means. The extended timing of any additional firming that may be needed, and before they said further policy firming may yet be needed. So again, I think yet coming out again is probably
but also
significant.
the way I mean, not to parse this too ridiculously, but
which is what we're going to do anyway.
They did structure that sentence about policy firming differently than they have in previous releases.
Most definitely different, and there seems to be something more of maybe an argument on the Fed, unlike what we saw in the minutes from the May meeting.
All right, let's go to Rick Santelli, get a little bit of what's going on in the bond pits and reaction here. Rick, what are you seeing so far? Looks like we're yields dropping a bit here.
Well, I guess the knee-jerk reaction has to be expressed in one word: rally mode. They really juiced up the prices. You saw the treasuries rally, pushing yields. I saw a quick yield in the 5-year note under 5.15. I believe I saw a very similar yield in the 10s. Now, granted, they're not at their best levels, but there's nothing on the curve now that's above 5.25, 5.21 in 2s, 5.23 in 30s. But the biggest, quickest reaction, other than buying there, was the Fed funds and euro dollars. Those, of course, price in possibility of what the Fed's going to do. They rallied dramatically. You heard a big groan as everybody ripped off their lotto tickets looking for 50. And indeed, we moved into the mid 60% on the August meeting. And of course, European investors, they really bought into the possibility of 50. So of course, the dollar went down, but that's kind of surprising. The dollar
Rick, let me add, it's
yes.
across the curve here. The decline, the expectations for October have dropped, and November, along with September, and we're about 69%. We went into this at around 79%. So backing off, the market is backing off of August. The idea maybe they were a little bit too certain. I don't think the market should make the mistake of thinking that August is off. I think August is 50-50 or somewhere around there right now.
By the same token, Steve, historically, this is a place where, for investors, if you were to buy the 2-year note, this is the single best performing Treasury instrument as the Fed prepares to end its rate hiking cycle. So that may be something that professional money managers will start looking at on a leverage basis, because if the Fed is nearing the end, they get a lot of bang for the buck in that trade.
But the bottom line is here, and we got to take a break, but the bottom line, I just want everyone to agree, is that they've opened the door here for a pause. They're no longer rhetorically blocked into expectations or set in stone of what they're going to do.
Ever so gently. They've taken another step, but saying, wait a second, we're still vigilant about inflation, we're still worried about it, we're going there, we're not there yet.
All right, we're going to take a break. When we come back on Street Signs, inside the hollowed halls of the Fed, we're going to be talking with Bob McTier. He is the former president of the Dallas Fed. He's been in the room when these big rate decisions are made. And let me tell you, this is one of the biggest we've had in quite some time. The Dow Jones Industrial Average up about 100 points since the decision crossed. We're up 170 points right now at 11,145. Street Signs right back here on CNBC. Well, you see the Dow Jones Industrial Average, and we have a rally on our hands on the back of the Federal Reserve, hiking interest rates by 1/4 point as expected, saying there might be some more down the pipe, but really toning down some of that talk on inflation. And you can see we're also getting a rally in treasuries as well. Yields falling to 5.20. They were at 5.22 before the statement. The dollar about one of the only things actually losing ground on the back of this, but certainly a big rally in equities. And Ben Bernanke is now formally the voice of the Federal Reserve. He is the captain of a team, and that team is going through unprecedented changes. Only 2 of the 7 governors from last year's June meeting were at the table today. And all this change as inflation has stubbornly continued to build, so much that the markets have been thinking the Fed could raise rates again at the August meeting. So now let's spin it forward. Fed Chairman Ben Bernanke facing the most important test of his lifetime, and who better to weigh in than the man we have with us now, Robert McTier. He spent many years sitting at that table as president of the Federal Reserve's Bank of Dallas.